That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Amy Wu Silverman, as well as Yahoo Finance's Ali Canal, joining us here to break down the moves today. Ali, let's start with you on that close.
Well, Josh, we were able to book some gains today, a reversal from some of the losses we saw in the previous two sessions. We had the Dow closing up around 200 points, the S&P 500 up about 0.6%, and the Nasdaq, the leader here today, up nearly 1%. Now, that was helped by Nvidia, which hit a $4 trillion market cap, the first publicly traded company to do that here. And you can see we finished the trading day just shy of that $4 trillion number. We hit it pretty shortly after the opening bell. Still, we saw shares close up around 2%. And it wasn't the only mega cap company to see some solid gains here. Amazon, Alphabet, Meta, Microsoft, all booking some upside gains. Now, I will say Apple eked out a little bit, 0.6%. Tesla down 0.6%. And that really paints the picture of what we've seen since the start of the year, where we have certain Mag 7 stocks outperforming and then others just aren't. Apple is one of them. If we take a look at a year-to-date chart, you're going to see Apple is down around 16%. Tesla, it's even worse. We are down roughly 26%. Now, these are both company-specific stories as well as macro headwinds. For Apple, they are very much exposed to the tariff picture, particularly with China and the products that they manufacture over there. And then for a company like Tesla, there's been growing concern among investors that Elon Musk, his political entanglements, that's distracting from some of the core issues at that company. But still, overall, a pretty good recovery in large cap tech today. And if we take a look at a sector action, you'll see that some of the leaders here, utilities, industrials, tech coming in third, it points to this rotation that we're seeing throughout the rally. It's not just all about tech, it's really some other leaders there. And then again, if you take a look at a year to date, that point is just driven home. Industrials, the #1 sector since the start of the year, Josh.
And Amy, just interested to get your thoughts on what you made of the trade today.
Yeah, I think two things. First, specifically on Tesla, it's actually one we're actually seeing call activity. So this is a stock where, 2 years ago, people couldn't get enough upside in Tesla. Things have certainly changed. There's a lot of tweet risk going around, but the options activity has been interesting because it's been placed in front of earnings and it's been relatively bullish.
So you're talking Tesla. Of course, another big name today we know, that would be Nvidia, just became the first company in history to hit a $4 trillion market cap. But what does that number really mean? Well, we're stacking it up next to other corporate giants and even some national economies. Joining us now is senior reporter Ali Canal with more on that one. Ali.
Yeah, such a historic moment here, Josh. And let's put some context behind this number. At a $4 trillion market cap, Nvidia is now worth more than Apple, Microsoft, and even Saudi Aramco. It's bigger than Germany's entire economy and almost twice the value of the entire Russell 2000 index. And if that's still not enough to show you how dominant this company has become, you'd need 3 Metas just to get close to Nvidia's valuation. Plus, it's also worth more than Disney, Netflix, and Comcast combined. So the big question here is, how have we arrived at this moment? Well, it all starts with those AI chips. Nvidia secured a near monopoly on the tech that powers today's biggest AI models, and demand from companies building out these massive AI data centers that sent revenue soaring up more than 200% year over year. But what's even more wild is how fast this rise has been. If you take a look at this chart from Bespoke, just over 2 years ago, Nvidia wasn't even in the $1 trillion club. It hit that milestone in June 2023, then doubled to $2 trillion in just over 260 days, hit $3 trillion 3 months after that, and now here we are today. And if history is any indication, these mega cap milestones, they tend to draw even more investor interest. On average, stocks that cross into the $1 trillion club rally another 9% over the next 6 months. Nvidia's done even better, averaging gains of more than 26% after each new market cap milestone. That being said, there are still some valuation concerns, since at each one of these breakthroughs, Nvidia has traded at an average of about 38 times forward earnings, making it one of the most expensive mega cap stocks out there. But here's the twist. As Nvidia's market cap has climbed, its valuation has actually come down. So in other words, it's become quote unquote cheaper, even as the stock has gotten more expensive, a trend that we really haven't seen with other tech giants like Apple or Microsoft. And that's why many on Wall Street believe this stock still has more room to run even at these levels. Sources I've spoken to say Nvidia could be on track for a $6 trillion market cap in the not so distant future. Still, that is a high bar. We just got to $4 trillion. Nvidia, the first company here to get it done, showing that we're in this defining moment, not just for Nvidia, but really what this AI boom could become for the entire tech industry.
All right, thank you, Allie. And Amy, your thoughts as well. You know, we're heading right into Q2 earnings here. Now, Nvidia's not going to report till later, but I'm curious what you see there.
Yeah, so it's going to report August 27th. It's one of the later reporters. Right now, we see both the put options and the call option wings relatively inexpensive. Now, one, that's because it's going to report in some due time. But the second aspect of that I think is interesting is as it gets bigger and bigger, it becomes a larger proportion of the benchmarks that everyone has to benchmark to. And so watch the call wing closely, because if people feel like they must participate, you're going to start to see that tick up in the volume, especially on the upside. That's what we've seen time and time again ever since May of 2022.
What did Ryan Dietrich tell us earlier in the show? I think what we count on in life, he said, is a death, taxes, and Nvidia.
Nvidia going up, right?
Nvidia beating. We'll see. All right. Well, joining us now is Julian Emanuel, Senior Managing Director, Equity Derivatives and Quantitative Strategy at Evercore ISI. Julian, it's always great to see you. So you note here, Julian, how the market has been a roller coaster. I think most people would agree with that, Julian. That seems fair. You provide some history here. You ask, what happens when that roller coaster returns to the top of the hill as it did in late June? What is the answer to that question, Julian? What did you tell clients?
So the answer is that if you look out 12 and 18 months later, the market invariably continues to rise. That's the very good news. The average is 26%. The news that I think particularly now, particularly sort of as you head in towards seasonality that starts to be less favorable in August and of course September, we don't even need to mention September, at these valuations, is that continued bull run comes with drawdowns on the order of 7.5% to 15%. And from where we sit and where we think about the likely impact of earnings, our view is that you are really sort of in the zone where there could be a potential pullback.
So given that history, given that backdrop, Julian, what are you telling clients in terms of how they should be positioned here?
So again, this is one of these ones where the advice that you render is completely dependent on how you manage your own financial position. Long-term investors, we're actually telling them to go ahead and enjoy their summer vacation, try and spend as much time in the mountains or the beach as they can. Because frankly, and if you think about it, and if you think about that return to the top of the roller coaster, if you had been ignoring the news, the headlines, and the volatility, it would have been a Rip Van Winkle type of situation where you woke up and essentially nothing happened. And here we are. There is no recession in sight. There is reasonable growth, but again, you do have high valuations. For those that are more active investors, our view is you want to add, and it's good that you've got Amy on the program this afternoon, is that you want to add an element of optionality to your portfolio. Because frankly, if we're wrong in our view of a pullback, it's likely to be the reverse scenario, sort of a 1999 FOMO type melt up. And in that case, we like the concept of optionality in the portfolio. If you're using stocks, you want to have low valuation stocks, low multiples, and strong earnings revision type names across sectors. Think about it. They tend to cushion the downside. And in fact, if the capital market cycle heats up, those are the type of the names that could be acquisition targets. Conversely, if you use options, we think triple Q option volatility is extremely attractive here. And at these levels, you can actually afford to hedge for both the drawdown potential that we see and the melt-up potential if we're in fact not right about that view.
If you saw the pullback, Julian, how would you expect investors to react? They dive back in, they buy that dip?
Well, I think, and again, credit to the retail investor who has consistently learned the lessons since 2020 of buying the dip. And I think one of the most unusual aspects of this, frankly, bear market that we had from the February peak to the April trough is that the retail investor was much more patient and actually bought the weakness, whereas institutions really were in risk reduction mode. So we do think that a dip would be bought. And from our point of view, consistent with our work, 7.5 to 15% downside seems right because frankly, we don't see the potential for a recession shaping up here. And so, drawdowns of, on the order of 20% or more just really don't make sense to us at this point.
Amy, just to bring you in here, because we were talking about this issue earlier, you would argue, Amy, correct me if I'm wrong, if we saw that dip, you would expect folks to move in.
Yeah, exactly. It's interesting because, like Julian said, there's really been this volatility regime post-COVID, which has looked very different than the pre-COVID regime. It's much been more about the right tail. So essentially the idea that you have FOMO and a chase to the upside, you don't want to be underweight, you have to jump in the pool. All that has made that fat tail not necessarily about downside, but about missing out if we do get that big bump up, for example, like post-Liberation Day.
Julian, I have to ask you while I have you, Nvidia hits $4 trillion today, remarkable milestone for that company, for CEO Jensen Huang. What are you advising clients about just the mega AI trade and theme here, Julian? I think when most people think about AI names, they are thinking Nvidia, they're thinking Microsoft and Broadcom, which have had these just tremendous runs, Julian.
So we at Evercore ISI launched coverage with very comprehensively. Really, it's amazing. Over 2 years ago now, with a very positive structural view on AI. And so if you think about all the sort of potholes in the road, I'm thinking DeepSeek and others over the last several years, the theme has been able to overcome all of it. And to us, the proof of the pudding is the fact that those sectors that had lagged into the downturn, and if you think about it, Nvidia really spent the better part of a year moving sideways. And to your point earlier, it gets cheaper on a multiple basis because the stock is catching up to where the earnings are going. We think, those structural AI leaders, the enablers, continue to be attractive. But what we've seen that's different this year is that the adoption amongst corporate America, not just for cutting costs, but also for figuring out how to enhance revenue, is occurring across industries. And the companies, we call them the enablers, the adapters, and the adopters, that are going to excel in creating a competitive moat by use of AI are going to continue to take market share and, in our view, increase share price.
Final question, Julian. Nvidia was making headlines today. So was President Trump, right? Because he continues firing off these tariff letters, Julian. What's interesting is how the market responds, which is with a shrug, Julian. I'm just looking at the popular averages, green everywhere today. And I'm just curious what you make of that market response.
No question. And it is a bit of a head scratcher. I would say that, though, today in particular, if you look at those letters sent, they were smaller countries, not really sort of the biggies like the EU or Canada or Mexico or India. So those are presumably still in the crosshairs of deals getting struck, potentially, of course, before August 1st. And I do think that, again, the behavior of the overreaction into April with a tariff regime that actually is not that far away from where conceptually we could land at this point is probably almost inversely proportional to the yawn that we're seeing now. And we would argue, again, given how far the market has come, that yawn may be a bit premature.
Julian, it is always a pleasure to have you on the show. Thank you for joining us.
Thank you.
Merck announcing it will acquire Verona Pharma for about $10 billion as the pharma giant continues its run of acquisitions. Evan Siegerman, BMO Capital Markets Managing Director of Biopharma Equity Research, who has a market perform rating on Merck, joins me now to break down that deal. Evan, my friend, great to see you as always. Let's talk about this. So Merck, all right, going to buy Verona for about $10 billion. What do you make of that, Evan? Does it make sense to you financially and strategically?
I think financially and strategically, it does make sense for Merck. But remember, they have a huge LOE loss of exclusivity event later in the decade when Keytruda goes off patent. It's not going to go to zero while biosimilars, but even if they lose 50% of the $30 billion market, that's still $15 billion that they have to make up. I think peak sales for the asset that they are going to get from Verona, $1 to $2 billion, maybe a couple billion more if they can get an indication expansion. So they have a lot more work to do.
You think, Evan, that Merck keeps hunting for other targets, other acquisitions? Would there be any on your radar that you think, okay, that would make sense for their portfolio?
So it's pretty clear that they're looking outside of oncology. This is a respiratory, asset. I think that they probably want to get leverage, diversify their portfolio. They talked about potentially cardiometabolic. We can go through the obesity names, maybe some of the MASH-focused names, more in kind of the respiratory space. There are other names with assets that are on the market. But I think that, they are going to diversify away from oncology. That's still their bread and butter. But it's pretty clear that this is kind of the sweet spot they want to be in.
You, Evan, have the equivalent of hold on Merck, right? You're lukewarm on this one. You're on the sidelines. What would you need to see, Evan, to get more enthusiastic about this name?
That's a great question. So we downgraded shares of Merck from outperform or a buy to market perform or a hold in December. And the genesis of our downgrade was, one, issues with their Gardasil franchise really stemming from issues in China, but also some other commercial issues that could be arising now. And two, the big hole that Keytruda is going to cause in their P&L. We don't have an answer to that. And my criticism of them is they need to really come up with a concrete plan and execute on this. This is a great first step, but I need to see more.
Let's switch gears. I want to talk a little bit about President Trump. He's making these threats, pharma tariffs, Evan. I'm curious what you make of them. Are we really going to see 200% tariffs?
I don't believe so. We've been talking about tariffs, pharma tariffs, since at least April at this point. I think this is more of a negotiation tactic, throwing out something kind of crazy to see how the market and the sector reacts. What I believe President Trump and his administration wants is manufacturing here in the United States. If you go through the list, many of the companies that I cover, Lilly, Merck, Regeneron, you name it, have announced expanded investment for manufacturing here, which is great, which is what he wants. There's also this Section 232 investigation going on, looking at the national security implications of outsourced or OUS production of key pharmaceuticals. So we'll see what happens with that. But again, I don't see 200% tariffs in this sector at any point.
Evan, always great to see and to have you on the show. Thank you.
A pleasure. Thank you.
Samsung hosting its flagship Galaxy Unpacked event. Yahoo Finance tech editor Dan Howley was there on the ground, and he's joining us now. Dan, what did you see? What did you learn?
Besides those stunning photos that I took the other day, a lot. Samsung announced their new Z Fold 7 and Z Flip 7. You might be wondering, well, it's the seventh in a line of foldables. What's the difference? The big deal here is that Samsung has finally, it seems, made foldable phones that are truly worthwhile when it comes to comparing them to a regular candy bar phone. So your iPhone, your Pixel phone, your regular Samsung phone, those are candy bars. Foldables are the ones that open like a book or might flip up like an old makeup compact or a foldable phone that you might remember. The big deal with them in the past has been they've been clunky and heavier than a regular phone. You think, okay, well, there's a trade-off for getting this larger unfoldable screen. Now that's not there. I was going hands-on with the Fold 7, and truthfully, it's wildly skinny. It's really about the thickness of Samsung's own S25 Ultra, and then when you unfold it, when you have it open up, it's literally a hair thicker than the USB-C port at the bottom. So it feels like the limiting factor now for how thin the phone can get is the connector to charge it. It's outrageous. It does feel great when you use it. I used to complain about the front screen on it being a little too narrow for what I wanted to type. I got kind of fat thumbs. They widened that, so it's a lot better overall in that respect. And then the flip is kind of the little party animal of the two. It's meant for selfies and fun things along those lines. That now has a full cover screen, so it goes edge to edge on the front. You take selfies with that. You can also load up apps. They have a special labs mode where you can run your different apps on there, and then that also got a larger screen in the middle and is also a bit lighter. So I mean, they've done a great job here as far as the phones themselves go. I got a caveat though. The price is still way too high. It's $1999 for the Fold 7 and $1099 for the Flip 7. So, these are fantastic examples of what foldable phones can and should be. The price, though, look, I'm not going to be rushing out to spend $2,000 on a phone at any point, right? Doesn't matter who makes it. If they made this less expensive somehow, I'd be picking it up, no problem.
What about the AI features they talk about, Dan? Who do they partner with for those features? Are they teaming up with Google on that?
Yeah. Okay. So they have Gemini Live on the cover of the Z Flip. You can now access directly from that cover screen. And they talk about how they have different Gemini features. Look, this is kind of, I think the thinking originally with smartphones was, here comes AI, boom, everyone's going to want to go out and buy it because AI. And it's like, no. Cool, you can rewrite a couple of sentences. Cool, you can edit, like, I don't know, the jogger out of the background of this photo of like my kids or whatever.
Yeah.
Great, awesome. Do you want to spend $1,000 just for that? No. So I think it's what's happening with AI and what's going to continue to happen with AI. And on the PC side as well is this is just going to slowly become part of our average workflow. It's not going to be this wow, big feature that I have to get. It's just going to be sprinkled throughout different parts of the operating system, and that's great. And then eventually you'll look back and say, well, I don't want a phone without it, because then I lose all of these features that I've become accustomed to over the years. I don't think there's ever going to be a big wow moment when it comes to the AI aspect of phones. I think it's still going to be the hardware. And when I looked at the Fold 7, I didn't say, wow, look at the AI on it. I said, my God, how did they get this so thin? And how did they get the screen to be so large in this package? That's what gets me excited.
All right, Dan, thank you, sir. Appreciate it. Time now for what to watch Thursday, July 10th. We're going to start off on the earnings front. We're going to be getting some more reports from Delta, Conagra, and Levi Strauss. Delta announcing results for the second quarter on Thursday. Analysts expecting profits to fall for the airline in Q2, driven by weaker domestic demand and lower ticket prices as consumers continue to be cautious in the face of inflation. Taking a look at the Federal Reserve, more Fed commentary coming out on Thursday from Fed Presidents Alberto Musalem and Mary Daly. This is coming after the Fed releasing its minutes from the May FOMC meeting on Wednesday, giving us more insight into the central bank as it approaches its next interest rate decision. And moving over to housing, we're going to be getting weekly mortgage rate data from Freddie Mac on Thursday. 30-year fix currently sitting at 6.6%, marking the fifth consecutive week of declines. And finally, initial jobless claims figures, they're coming out on Thursday. Economists forecast that number to tick up compared to the week prior, 235,000, signaling a slight increase in layoffs.